Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Monday, everybody. I trust you had a restful weekend. I wish you all a productive week ahead. As we usually do on Mondays, we have an economy-focused episode for today. First up, over the weekend, Beijing's Customs Administration published the official trade numbers, and according to these data, China's exports declined in March, shrinking 0.7% in dollar terms from a year earlier, while imports fell 1.9%. Both numbers are well below economist forecasts. The fall in the value of exports comes even as volumes have been soaring and underlines the challenges facing Beijing as it turns to manufacturing and trade to try and steer the economy out of a deep slump induced by a slowdown in the property sector. Quote, taking the positive surprise seen earlier this year, we still view that exports should be on a recovering trend, but modestly. The data may also lead to some less aggressive expectations for first quarter GDP out next week. End quote. That number is due tomorrow, Tuesday, along with other data from retail sales to industrial production. Some economists also said a higher base of comparison last year partly led to the export drop, noting production had jumped last March as workers recovered from a wave of COVID-19 infections. Let's dig into the numbers a little bit more. Chinese automakers exported 1.32 million vehicles in the first quarter of this year, up 23.9% from a year earlier. Customs did not give a breakdown of how many of those were electric vehicles, which, as regular viewers know, is fueling increased frictions with the US and Europe, along with other green tech exports. While overall exports weakened last month, steel shipments were the highest since July 2016, jumping 30.7% in the first quarter. Back then, the European Union, the US, and Japan complained about Chinese steel overcapacity driving down global prices. Fertilizer exports led the decline with a 52% plunge in the first quarter from the previous year, probably reflecting Beijing's effort to secure domestic supplies and stabilize prices, in the words of a Bloomberg economist. Chinese export prices fell through February, and that deflation means any rise in demand will not translate into higher profits. We remember from Saturday's video that producer prices fell in March for an 18th straight month. Bloomberg writes that the unexpected drop in imports adds to worries that Chinese consumers, still feeling the impacts of the property slump, have little appetite to spend and, quote, deflation remains a threat, end quote. Meanwhile, UK-based The Financial Times reports over the weekend that activity on China's equity capital markets on the mainland and beyond has slumped to a multi-decade low, quote, highlighting how the loss of momentum in the world's second-largest economy has weighed on investor confidence, end quote. According to Dealogic data, Chinese companies have raised just $6.4 billion in mainland IPOs, follow-on and convertible share offerings so far this year, the lowest level on record. Their fundraising in offshore markets, including Hong Kong, the outlet explains, is $1.6 billion, the lowest year-to-date since 2003. China's outbound M&A, mergers and acquisitions, of $2.5 billion is the lowest recorded amount over the same period since 2005. On international bond markets, Chinese companies, banks, and government borrowers have issued $26 billion so far this year, slightly above last year's $24 billion, but otherwise the lowest level since 2016. On the mainland, borrowing of $246 billion is up 17% on last year. Wang Qi, chief investment officer at UOB Kay Hian in Hong Kong, told the Financial Times, quote, in terms of global investor interest in China, it's definitely the worst I've seen in my career, end quote. Wang has been working in financial services since the early 1990s. Another unnamed source involved in China's financial markets told the outlet, quote, it doesn't matter what type of investor you are, it still looks murky. The economic uncertainties haven't yet dissipated, end quote. The outlet argues that the capital markets data reflect a climate where China's financial system has become increasingly isolated despite the ending of the pandemic. Quote, at this stage in 2021, Chinese companies had issued $61 billion of equity outside the country, 39 times more than the volumes so far in 2024. Corporates had issued $39 billion of bonds, almost 4 times the current rate. International banks, which for years sought to make inroads into China's vast financial system, have had to grapple with shrinking levels of activity. End quote. New equity issuance onshore is down 83% year to date. Quote, international firms have also had to navigate mounting geopolitical tensions between Beijing and Washington, where a select committee has scrutinized American business on the mainland. Tensions weighed on outbound M&A activity last year, but at this stage of 2023, volumes were more than 3 times higher than the current rate. End quote. Next up, we have one more economic update to cover, but just quickly, if you are getting some value from today's episode, I have a favor to ask. That is to like and subscribe. It's only 2 clicks of the mouse, but it's a huge help for the channel. The algorithm is the only way in which the channel can grow. Patreon and Buy Me a Coffee links are also in the description below for those who want to help me keep the channel financially sustainable. Thank you so much, everybody, for the ongoing support. Last week, we briefly looked at comments made by Xu Gao, chief economist at the Bank of China and a professor of economics at Peking University. Since then, Chinese financial media outlet Caixin has published a piece by Xu based on a speech he made at a recent conference hosted by the National School of Development at Peking University, with some content added by the author afterwards. The piece has been published in both English and Chinese and has been widely read already. Xu's points are therefore at the center of the current debate, the policy debate in China surrounding the structural issues in China's economy generally, and the issue of weak consumption specifically. One of Xu's key arguments is that the cause of China's high savings is a disconnect between the corporate and the household sectors. He argues for a transfer from businesses to households as a way to rebalance. This, of course, is much easier said than done, but it is an argument that was once contrarian, but is now increasingly mainstream, including in Beijing. Let's examine some of this new piece, which we will now quote selected excerpts from directly. In light of subdued domestic consumption, China has 3 options to tackle economic headwinds. The best way is to restructure its income distribution system. A backup plan could be stabilizing economic growth through continued investment, while the income distribution transformation is in progress. As a last resort, the government could halt investment stimulus, while income distribution restructuring has yet to take any shape. But this should be avoided. For a long time, the constraints of China's economic expansion have been rooted in demand, rather than supply. Demand consists of 3 parts: consumption, investment, and exports. The key reason for China's tepid demand lies in insufficient domestic consumption. To be more specific, household consumption is too low. Globally, excluding China, in countries with a per capita GDP exceeding $10,000 in 2005 constant prices, household consumption as a proportion of GDP is about 55% on average. In China, per capita GDP has reached $10,000, but the proportion of household consumption is now about 15 percentage points lower than the world average. The low consumption to GDP ratio indicates that households are not fully benefiting from the country's economic growth, and that there is a high savings rate. China's current savings rate, savings as a percentage of GDP, is more than 40%, about twice the global average. The cause of China's high savings is a disconnect between the corporate and the household sectors. Data from the vast majority of countries over the past decade indicate that there is a negative correlation between corporate savings and household savings. This is because when corporate entity is held by individuals, whether business income goes to the household sector or is preserved in the corporate sector, it will ultimately become household wealth. However, in China, it's a different picture, as both corporate and household savings as a percentage of GDP are high. The negative correlation between the 2 measures does not apply, and one of the main reasons is the presence of a large number of state-owned enterprises. The majority of state-owned enterprises' equity is held by the state, resulting in most dividends flowing to the state rather than to the household sector. Of course, state-owned enterprises support the national economy by paying wages, taxes, and dividends to the state. However, the problem is that Chinese household sector cannot directly feel the impact on their personal wealth, As a result, the dividends and savings of state-owned enterprises have a relatively weak role in driving household consumption. There are three potential solutions to tackle these issues. The optimal solution is to reform income distribution through a national SOE shareholding scheme. The ultimate goal of this scheme would be to boost consumption by increasing household income. External demand is largely out of China's control, and growing trade protectionism abroad has placed barriers to Chinese exports. Therefore, overly relying on exports is not a viable strategy for China. This leads us to the two other options. What could be a runner-up solution is for the government to continue stimulating investment to create demand and promote growth, while domestic consumption remains sluggish. Of course, the strategy has its drawbacks. For example, China's large-scale investment in infrastructure has already created a huge debt burden for local governments. Also, the high-leverage model typically employed by property developers has proven potentially traumatic. As a result, China has become more cautious when it comes to stimulating investment in recent years, and even implemented policies aimed to deleverage the real estate sector, which, as the years-long property crisis continues, has adversely impacted the industry. Such seemingly reasonable measures do more harm than good, and, in my view, are the worst way out. Following this plan, the third option would be to stop stimulating or even suppress investment before substantial progress in reforming income distribution has been made. But this would only make the problem of insufficient demand more acute, forcing supply to contract, which would put the Chinese economy at greater risk of repeating the deflation experience from 1998 to 2002. Although China's economy is currently facing downward pressure, policymakers still have a lot of room to maneuver and are fully capable of ensuring stable economic growth. In the future, China needs to resolutely avoid the third solution, use the second to buy time, and finally use the optimum approach to resolve its economic structural problems. Here ends the direct quote. Xu's piece has sparked more debate in the wider conversation on these themes. Quote, I'm not sure that his solution to redistribute income from SOEs to households will be easy. It involves substantial institutional changes, including, among other things, a major shift in revenues away from local governments. But this is exactly the sort of discussion we need in China. It is not enough to argue that households must retain a larger share of GDP. The key is to decide which sectors will pay for the transfers and what the costs to the economy will be. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a lovely Monday, have a productive week, and I will see you all tomorrow.